Hello everyone. Today we're going to talk about marginal and absorption costing. This is one of the most challenging topics of management accounting. So the objective of this topic is to understand the differences, advantages and disadvantages of marginal and absorption costing. We're going to go through the definitions, scope, then key concept, differences in treatment of these costs. So the differences between the marginal and absorption, key differences between them. And of course, we're going to see the examples in order to understand in more detail. So let's start. What is marginal costing? The definition of marginal cost is that it is additional cost incurred by producing one extra unit output. So costs are in general divided into two: fixed costs and variable costs. As we know, fixed costs include loan payments, salaries, insurance premiums, rents, administrative costs, the costs that do not change and doesn't depend on produced items, the volume. So it doesn't matter if we produce or not. Anyway, we need to pay our loans. If we have, anyway, we need to pay some salaries because we cannot just lay off our employees for the period when the production stops. Then anyway, we need to pay for the rent. Anyway, we have any other administrative costs. So the costs that um, don't depend on the produced items, the volume, or cost are called fixed costs, and the variable costs are the costs that related directly to our produced item. So, for example, if we have standard rate for our labor for production of one unit, then it is called the labor direct costs, labor wages. So we have utility expenses, and we can pay as much as we use electricity, water, etc. Also, such costs like sales commissions, we pay for sales agents depending on their sales volume. The packaging costs also depend on the unit and the package that we use, raw materials. The important thing that you need to understand and remember in this topic is that variable cost is not, it doesn't equal to marginal cost. Variable cost can be production or non-production, and marginal cost mostly include marginal production cost, which consist of direct material, direct labor, and variable production overhead. So if you see here, variable production cost also at the same time doesn't equal variable production cost. Why? Because this is a node, not because the marginal cost not always constant. Look at the situation when, for example, in usual we buy um, raw materials, for example, 1,000 units, and we decided to buy 1,100 units, and supplier has a discount, 5% discount for the purchases over for the purchases over 1,000. So these discounts are um, considered in marginal costing because we are buying 100 more. That's why we get this discount. Also, it can be incremental fixed costs such as overtime. For example, our labor, we agreed with our labor, and it has a stand. She or he has a standard that he should produce per day 100 units, right? But we have a big order, and we ask our employee to work extra and produce not 100 but 110 units. So this overtime cost is also marginal cost for those 10 units that we asked our labor to produce. And also, we may need additional machinery to produce those 10 units because we know that capacity of our machinery is for 1,000 unit, and because we have a big order which is little bit more than our usual capacity. For 100 units, we need additional machinery, and this cost is also considered as a marginal cost. Another concept that we need to really understand in this topic is contribution. What is contribution? Contribution is selling price minus all variable costs. So in marginal costing, contribution is important. Let's see the examples of marginal costing. For example, consider a company that makes hats. Each hat produced requires 0.75 of plastic dollars of plastic and fabric. Plastic and fabric are variable costs. The hat factory also incurs 1,000 of fixed costs per month. If the company makes 500 hats per month, then each hat incurs $2 of fixed cost. It's really easy. 1,000 we just divide by 500 hats. So in this example, simple example, the total cost per head would be 2.75. So $2 of fixed cost per unit and 0.75 variable cost. Really easy, really simple. If the company boosted production volume and produced 1,000 heads per month, then each head would incur $1 of fixed cost because our fixed cost didn't change. It stays the same, 1,000, and we divide it by 1,000 heads. So the total cost per head will be, in this case, 1.75. In this situation, increasing production volume causes marginal cost to go down. So we don't have extra marginal cost. If the head factory was unable to handle any more units of production on the current machinery, then the cost of adding a machine would need to be included in the marginal cost. Assume the machinery could only handle 1,499 units, and the 1,500th unit would require purchasing an additional $500 of machine. So only for one unit that we need to produce more, we need to pay now $500 because we need an additional machine. So this is also a marginal cost, additional cost in order to produce that additional one unit. I think the marginal costing concept is clear. Let's go now to the absorption costing. So absorption costing allocates both variable and fixed production costs of products. Key points are that fixed costs are absorbed into the cost of product. So we just add fixed, as we saw in our example, when we calculate the total cost, we add fixed cost per unit to our unit cost. It aligns with the financial reporting standards because in financial reporting standards we need to show all the costs related to the unit. So it includes, as you see, direct labor cost, direct material cost, variable manufacturing overhead costs, fixed manufacturing overhead. And when you sum up all of them and divide by number of units produced, you will get absorption cost per unit. Well, let's go through the example of absorption costing. Assume that ABC company makes widgets. In December, it makes 1,000 widgets, of which 8,000 are sold by the end of the month, leaving 2,000 still in inventory. Each widget uses $5 of labor and materials directly attributable to the item. In addition, there are 20,000 of fixed overhead costs each month associated with the production facility. Under the absorption costing method, ABC will assign an additional $2 to each widget. It's simple, 2,000 we just divide by 10,000 widgets. And the absorption cost per unit is 7, as you see, the variable cost, $5 of labor and materials, and 2 fixed overhead costs. As 8,000 widgets were sold, the total cost of goods sold is 56,007, just we multiply by 8,000. And ending inventory is also easy to calculate, just 14,000 because we have 2,000 widgets in ending inventory, and we just multiply it by 7. So this is absorption costing. As you see that all the costs are included, fixed and variable. Let's now look at the key differences of marginal costing and absorption costing. In cost treatment, you can see that fixed costs are period costs per marginal costing concept, and in absorption costing, fixed costs allocated to products. In profit calculation, profit in marginal costing is based on contribution margin. We can go back to the formula again. How we calculate the margin, contribution margin, is that selling price minus all variable costs. So this contribution margin is related to marginal costing concept. Again, let's go back to our key differences. Profit calculation by absorption costing. It includes fixed production costs also. Stock valuation. In stock valuation per marginal costing, we take only variable costs. But in stock valuation per absorption costing, we take both variable and fixed costs. When we use marginal costing, mostly in internal decision makings, but absorption costing we also use for our external financial reporting. So also let's see the differences between the absorption costing and variable costing. As you see in absorption costing, product costs include direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. So this is the product cost for absorption costing. But variable cost is, but in variable costing you see only direct materials, direct labor, variable manufacturing overhead. And the fixed manufacturing overhead are considered as period costs per variable costing. But per absorption costing, only period costs include variable sales and fixed sales and administrative expenses. Now let's look at the advantages of marginal costing and disadvantages. Advantages are that simplicity in cost allocation, because you just take them extra costs or just variable costs. It facilitates short-term decision making in order to understand, do we need to produce an extra item? We see how much we additionally we need to incur. It helps in identifying contribution per product. Disadvantages are that it ignores fixed cost in stock valuation, so stock valuation can be underestimated, and it may understate profits when inventory levels fluctuate. Let's now look at the advantages and disadvantages of absorption costing. Advantages are that it aligns with accounting standards. So in accounting standards, as you know, that not only variable costs are included in production costs, but only fixed costs. It ensures full cost recovery. So if you take the absorption costing and then calculate if it is profitable to produce any item, absorption costing will help you. Useful for long-term pricing strategies, as you always know that your all expenses are covered when you produce items. Then there are two disadvantages of absorption costing. One of them is complex cost allocation process, because you don't just take variable costs, but also you need to add up all the fixed costs related to production and then divide them by the total units produced. Profits can be manipulated through inventory changes. So now we need to understand when to use each method, right? Marginal costing, as we said, we can use in short-term decision making, so pricing or breakdown analysis, and for internal management purposes. But absorption costing, we can use in external reporting and compliance and for long-term financial planning. Now, let's see another practical example of the marginal and absorption costing. For example, production cost variable $10 per unit, fixed 5,000. and units produced 1,000, units sold 800. So we have 200 in our closing stock. For marginal costing, we just take $10 per unit, and it's going to be 2,000. So our closing stock will be 2,000. But for absorption costing, we don't take only 10, but also 5,000 divided by 10. It's going to be $5 per unit. So the total amount of our absorption closing stock per absorption costing will be 3,000 in this case. 15 divided by 200 units. I think for today it's enough, and I hope that this video was helpful for you. Thank you for watching, and for more videos, subscribe to my channels, Telegram and Instagram. See you next time. Bye.